Hello, how's it going? This is Rob with Maverick Trading, and welcome to our Levered ETF series. Today we're going to be talking about inverse ETFs, which aren't necessarily leveraged. Now look, there are leveraged inverse ETFs, but before we get into those, I wanted to make a video on exactly what is an ETF and how does an inverse ETF work. Before we jump into inverse ETFs, let's do a quick reminder of what an ETF is. Whenever you hear the term the stock market, that really doesn't mean anything. Look, there's several different exchanges where stocks are bought and sold on a daily basis and they go up and down. There's really no way to say, hey, how are all the stocks doing? And so they created these things called indexes that you could actually track what the market was doing, like the Dow Jones Industrial Average, the Standard & Poor's 500, the Russell 2000. And they created these as a way for someone to look at this number and say, oh, the market went up today, the market went down today, but it was just a collection of those 500 stocks that they put in there. In 1993, a firm called State Street created the first exchange-traded fund called the SPY, or as was called the Spiders. This was developed to deliver the same return as the S&P 500 index. The great thing about these is that it was a stock. It wasn't a mutual fund. It wasn't index. It could be directly bought and sold like a stock at any time at a really cheap price. This was a great alternative to mutual funds. Before ETFs, if you wanted to get the same return as the market, you had to pay a company probably somewhere around 0.5 or 1% to run the money to try to get you the same return. Now it's as easy as just buying SPY. And these have options, which is awesome. We're an options trading firm at Maverick, so we absolutely love options on these ETFs. ETFs are a fantastic way for traders, investors, anybody to get into the market. And again, you can get into the market like the SPY or the QQQs, which is the NASDAQ, but they've also broken them down into sector and industry group ETFs, something like the agricultural fund that owns a combination of agricultural stocks. Or you could do something like I want biotechnology. It gives traders and investors the opportunity to really hone in and say, this is exactly what exposure I want. Now, ETF trading is about 40% of all trading in the stock market right now, so it's huge. However, there are some severe limitations to what you can do with an ETF, especially in retirement accounts. So in retirement accounts, you cannot go short. With a regular ETF, there's no way to be short in a retirement account. There's no way to hedge out anything in a retirement account, and there's no way to be on margin and to amplify your returns. So there are some serious limitations to what you can do with ETFs without inverse ETFs. Here's what inverse ETFs are. Let's take that SPY that we talked about and say, you know what, I want to get the inverse return of the SPY. Whatever the SPY does, I want to get the opposite return. Well, that equals the symbol SH. The SH is the symbol that will give you -1x return of the SPY. Here is a side-by-side comparison of the SPY on the left and the SH on the right. And as you can see, as they move, they simply move opposite each other. As the SPY is going higher, the SH is going lower, because again, this is the inverse ETF. At some point, that SH will start to go higher, which means that the SPY has started to go lower. It's an inverse return of 1x on this. So let's talk about this world of inverse ETFs, because there is a whole other world out there, and there's a lot of popular ones there. We have the Dow. The inverse ETF of the Dow is called the DOG, D-O-G. The inverse of the SPY is the SH. As you can see, there are 2x and 3x leverage ETFs. We are going to be talking about those leverage ETFs in our leverage ETF series, where we cover pretty much every leverage ETF out there. So congratulations. You finally have a way to be short and hedge in your IRAs. That's the greatest thing about these inverse ETFs. You can finally be short and hedge things out in your IRAs. Here's a great website for you. It's simply the ETF database. So etfdb.com. It has pretty much every information that you could ever want on ETFs. You can go here, find your symbols, shows you how much volume they do, shows the multiplier of it, and basically you can go into this list and find any inverse ETF to use. Let's go over exactly when and how to trade inverse ETFs. The first way is the most simple way. It's simply directional trading. You either are going to buy it or sell it. Now, it doesn't make a lot of sense to sell short an inverse ETF because what you're doing is you're going long the actual ETF. It doesn't make sense to short these since you should simply buy the long ETF. So let's give an example of how to use this in a directional trade. Let's take an example of a directional trade that a trader may take. Now this here is the SH. This is the short S&P. So when it's going down, it actually means the market has been going up. So let's say that we are waiting for this opportunity where the market's been in a big up move and we think this wave is likely to be over. We want to look to be short. Now we can always just go short the SPY in a trading account. That's the same trade. But in retirement accounts, this is going to be the only way that you can go short. Let's say this trader is watching and says, okay, I see that we've got this nice trend line at this point. Once this trend line is broken and we see that the market is trading below its 50-day moving average, so again on the SH above the 50-day moving average, and let's go ahead and see if that breaks, and then let's buy the pullback. As you can see, we did break out. So at this point, it's very clear here that the market has just broken down. Now, yes, this could easily be an entry point somewhere in here. But as I said, a lot of times you don't really know how far it's going to break. We like to let it break and then buy the pullback. So once this finally tops out and pulls back, we're going to be looked to be a buyer at that point on SH. So as you can see, it continues to move, big candles, tops out, trades sideways for a little bit, and then starts to come down. So at this point, we're saying, okay, the market has clearly changed directions. We now have the 20-period moving average trading above the 50 on the SH, which means the SPY looks exactly the opposite of this. We just broke down. At this point, we want to say we want to look to be a buyer once this thing bottoms out and starts to go back up. So all we're waiting for is the candles, and we got a little candle right here. So this person could easily say, you know what, I want to go long here. I want to go ahead and buy, go long at this point. And of course, as a trader, you always have your exit point. You could even come out here and say, you know what, I'm going to put my stop down here below this last swing low, which is one of the places we like to use. Again, there's lots of ways to use stop placements. This is not the most common one or even the one you should use. We go into that exactly where to place stops quite in depth. So at this point, here's the trade. This trader's long at 14.43, stop down here at 14, and the trade's either going to work or it's not. Now, if the market keeps breaking down, you're going to see that this is likely to go up. If the market recovers, this is most likely to go down. So we're starting to get some price action our way, and we get a nice run up, and we make it up to the next level. Now at this point, this is a big, nasty, red engulfing candle. Well, it's not an engulfing candle, but it's a very, very bad candle. This is the candle that we teach our traders to exit on. So this would be the exit here on this trade. And you can see 1508. That was a nice, let's call it 4% return here by being short on the SH. As you can see, it's a very simple trade when it's a directional trade. You just put your entry point, your stop, your target, and you plan out your trade and follow it to the end. So trading these directionally is very simple. It's simply like buying or selling a stock. We are an options trading firm at Maverick, so we love options, and this is where we use them so many times to actually take exposure in these sectors and industry groups. So let's go back to that same trade. Let's take the example. The buy signal was generated on February 3rd, and the sell signal was generated on February 24th. Let's go into Thinkorswim's Thinkback, where we can actually go in and see exactly what the prices of the options would have been on that exact date on February 3rd when we bought, and the exact date on February 24th when we sold. Here we are on Thinkback in Thinkorswim, and I've changed the date to February 3rd. What this does is it's going to take all the options prices from February 3rd and give this the ability to see, okay, if we would have bought this strategy, just this strategy, which one would have worked better? Most of these inverse ETFs will only have monthly options, which is a little bit of a limitation, but not all that much. As you can see here, we've got some options to choose for. We can choose from options that have 15 days till expiration, 43 days, 106 days. I like to stick within the 10 to 15 day window for all of my trades, as I'm more of a swing trader. As you can see here, we've got all the prices here, and you could say, okay, what if I just bought the $13 call? So if you just bought the $13 call right here, and let's just say 10 contracts would cost you $1,400. What we now would need to do is we say, okay, what would this long call position be worth on February 24th? So we simply just jump forward, say, okay, we would have exited on that date. And you can see here, this would have ended up with a profit of $365. So we're looking at somewhere around a 20-25% return. Now we could take a look at some other different option strategies. We could take a look at something like, let's do a bull call spread. So vertical spread. And I'm looking to do the 13-14 or the 14-15. That's the one that I would have chosen. So as you can see here, here is the entry for this. We've got this vertical, bought at a debit of 35 cents. And let's go forward to 24th, which is, I just realized, past the expiration date of these options. They expired on the 18th of February. So, but you can see this position would have netted a gain of $440. This Thinkback is an awesome tool for anyone who's aspiring to get into options trader to go in and do some back testing and see, okay, in this situation, I would have done this or this strategy. Highly, highly recommend it. So go to our videos. We've got a whole library on Thinkorswim and how to use it. Another great way to use inverse ETFs is hedging. And this is really the best thing for any of you who have IRA accounts that you're sick and tired of seeing them really drop when the market goes into a little bit of a downtrend. These give you a great way to hedge everything out. Let's use an inverse ETF to hedge out an existing portfolio. So let's say there's a trader out there or an investor that has $50,000 of tech stocks. And the market starts to look really shaky. And they say to themselves, you know what? I don't want to sell my tech stocks because of tax implications or any other reasons, but I definitely think the market's going lower. How can I protect it? Well, we can simply go over and buy the inverse of the NASDAQ, the PSQ. Now remember, we want to try to match up whatever it is we're buying on one side. We want it to match up as close as we can to tech stocks. So if you own a lot of internet tech stocks, then you want to go find the inverse of the internet tech stock sector. So the market goes down 10%. You could see if you were unhedged, you would lose $5,000, 10% on 50,000. However, your long position went up 10%. So it went up $5,000. There was no loss whatsoever in the portfolio because the portfolio was hedged. Now look, it doesn't always end up being exact. Sometimes let's say that tech stocks went down 10% and the PSQ only went up 8% because again, your combinations of positions were different, but you saved some of it. This is a great example of hedging, and this is where, again, inverse ETFs really shine in retirement accounts. To finally be able to protect your money in down markets is a fantastic vehicle. So the answer to how and when to trade inverse ETFs, you can trade them all the time. You can trade them. They're just like stocks. So based on what you do as a trader, do you day trade stocks? Do you scalp stocks? Do you swing trade stocks? Do you position trade stocks? It doesn't matter. Do you buy and hold stocks? It doesn't matter. You can absolutely use these as a vehicle for your investments in your trading. Options trading, like I said, we are an options trading firm at Maverick. All of our traders trade options with the firm's capital. So we are very big fans of options trading and really think that all trading should be done in the options market. It's simply the best way to control your risk. And that is where this game is won and lost, is controlling and managing your risk. And then last, we talked about how great this is for hedging. And we use this all the time at Maverick. So let's say that there's a trader that has a lot of bullish options plays out there. And the market gets a little bit of news, and the trader thinks the market's likely to go down for about a week. They can go in and simply buy some of these inverse ETFs. And what that's going to do is, as their bullish options trades lose money, that bearish trade, which again is just simply a inverse ETF, is going to make back some of the money they lost. It's a great way to smooth out the rises and falls in your portfolio with doing a little hedging around the entire thing. That is it for inverse ETFs. Thanks for joining me. If you are not familiar with Thinkback from Thinkorswim, please go to some of our Thinkback videos. It is a fantastic tool for anyone looking to get into options trading. Goodbye.